Welcome to Yahoo Finance Live. I'm Shauna Smith along with Akiko Fujita. Let's get you up to speed on the market action. Investors cheering a lighter than expected inflation print. You can see it reflected in today's action with the Dow up just over 100 points. The S&P up about 0.8%. The Nasdaq, the leader among the three here, as investors are betting that a second rate hike may be off the table later this year. Banks among the leaders in today's action. You have Citi and Goldman both up just over 2%. Technology, as evidenced by the move that we're seeing in the Nasdaq, also among the outperformers in today's action. On the flip side, we're seeing some pressure in yields. Taking a look at the 10-year, that is moving to the downside here this afternoon, off just about 11 basis points. Then taking a look at the dollar slipping to the lowest level that we've seen in just about 15 months. All right, well, inflation is cooling. The consumer price index rising 3% in June from a year ago, the smallest annual gain in more than 2 years. For more on what this means for the market, we want to bring in Eric Friedman, U.S. Bank Asset Management Chief Investment Officer. Eric, it's good to see you. So it's evident here by today's market action that more and more investors are betting that maybe the Fed will be done after raising rates later this month. What do you think?
Yeah, sure. I think that's exactly right. You know, the probabilities have gone down for that September rate hike. I think if the Fed had a mulligan, which is something I need when I play golf, the space between next week's interest rate announcement and then not until the end of September, that's a long time period. There's a lot of data that's going to happen between now and then. But again, I think that today's CPI print was probably helped somewhat by what people like us look at data consider a strong base effect comparison. In other words, it was tempered somewhat by a tougher comparison period over last year. So net, it is good news. We want to see what next month looks like as well as the PCE data, but certainly heading in the right direction from the Fed's perspective.
What do you think is the bar for a second hike? I mean, certainly you could argue that September may be off the table, but there's still those out there who say there could be another rate hike coming by year end.
Yeah, Kiko, I think that's a great observation. And really, I guess the phrase that we would use is how much progress is there towards the quote unquote last mile of not just the Fed, but the Bank of England, the European Central Bank, that all have these 2% stated inflation targets. And we're still a long way from 2%. The move from 9%, where we printed last June, to 3%, where we printed this morning, I mean, that's a lot of progress. But that last mile between 3 to 2, there's still some real estate between now and there. So bottom line is that we think that anything that picks up higher in terms of like either a CPI or tomorrow's PPI data, but also PCE, again, you have to keep in mind that that's what the Fed cares most about, is this PCE gauge, as well as progress on what they're calling super core, which is, again, a very, let's call it, specific subset of inflation. So anything that suggests that, look, September should be back on the table, we think the Fed was going to have a bias for higher for longer as opposed to looking to cut rates. So the bar is not that high, but we'll have more data between now and then to really assess.
Eric, when you take into account what's happening within the labor market, right, and this points to wages keep increasing because the labor market remains very tight. If we do see 2 more hikes here from the Fed, how big of an impact, or what do you see the employment picture looking like as we get closer to the end of the year?
Yeah, Sean, I mean, one of the things that's really interesting as you looked at the data this morning was the increase in real wages. That's something that actually did tick a little more modestly last month, but really picked up in this latest inflation data. So bottom line is that we still think that the rumors of the demise of the consumer, the rumors of the demise of the American worker are really overstated, and the consumer is just hanging in there. So there's still a shortage of labor. That's true across any small business survey you look at, even though we did have some decent data yesterday from small businesses, that they're just having a tough time keeping people in chairs. So we still think the bias is for an ongoing healthy labor market. Our U.S. Bank economics team thinks it will avoid a recession because of the strength of the labor market and the consumer. So we still are pretty bullish on prospects ahead.
Eric, you've got the heart of earnings season kicking off tomorrow. PepsiCo and Delta leading the reports there, but we've got some big banks reporting on Friday as well. The expectation, or you could argue the bar, is very low going into this earnings season. What are you expecting in terms of surprises to the upside?
Yeah, Kiko, if you look at the bar, to your point, it's pretty low. There's a minus 7.2% expectation for earnings growth this quarter, and actually a 3% revenue decline. So investors are already set up for some level of a contraction on the economic impulse front. So where we think there could be some surprises is really twofold. Number one is news on CapEx from companies. That's going to be, again, a key marker for the technology sector, which of course has been up 40% from a trough to peak perspective, given today's move. That's a material move. It has to be backed up by CapEx. We think there's going to be ongoing spending in things like, obviously, artificial intelligence, big data, communication services. So the first upside surprise we think may be on CapEx. The second is the factors that really drive consumer spending. We think there could be some upside surprises there. Again, it's almost been this like monolithic painting of the consumer picture. There are a lot of subsets within consumers that are doing really well. There are some concerns that perhaps lower income consumers are going to hit a headwind with respect to wage growth, probably slowing down a little bit. But if you look at other cohorts, there still is a lot of momentum. So bottom line is that we think CapEx may be a bit better than expectations. We also think the consumer will likely be more resilient than Wall Street is perhaps giving it credit for right now.
So then, Eric, what does that tell us just about the pricing power that companies still do have? If consumers are out there buying, whether it's on goods, whether it's on experiences, then do they have a little bit more room to continue to raise their prices and pass down those costs to the consumer?
Yeah, Sean, I think it's a really important point and an observation you make. I'd say two thoughts. One would be there's some evidence that we've seen of consumer product companies, consumer staples in particular, probably towards the end of their pass-through cycle, just given what the consumers already endured. That being said, on the experience side, whether you look at hospitality, whether you look at travel and experiences, to your point, there still is that ongoing bid, not just because we're in the summer months and people take holidays, but there seems to be an ongoing demand for those experiential type of sectors to get some upside surprises in terms of pricing. So I think, certain goods are probably at the latter end, if you will, of their pricing power. But the experiences side, and also, again, scarce tech, it's maybe, circular reasoning, but scarce tech continues to have pricing power. The things that again, are going to make companies bigger, stronger, faster, they keep having the advantage that other companies don't. So those are, again, probably some gradients of differences across sectors, but we certainly think there's some pricing power left from the supply side.
So, Eric, let's talk strategy, where investors should be putting their money. Talk to me about these catch-up trades you're eyeing.
Yeah, some of the things, Akiko, that we're really focused on are not so much on technology. We came into 2021 fairly bullish. That worked out. 2022, we pivoted to be a bit more bearish. That helped. And we were a little too bearish to start out this year. We've been adding to equity exposure throughout the course of this year, both domestically and internationally, which has worked quite well. I think the thing that's next as a test for markets will be what happens with these quote unquote catch-up trades. When we say catch-up trades, it's the things that have really not been participating in what has been an otherwise narrowly led domestic equity market. So things like U.S. small cap, U.S. mid cap, those are areas that have not performed as well. The relative spread between small cap to large cap is about as wide as it's been in the past 5 years. We think that could be potentially interesting. Other things like real estate and energy. Again, real estate, we all know the issues out there in the office space and other parts of the real estate landscape. There's also lots of good things happening across areas like multifamily that again, when you have some yield component to a total return like you have in real estate, that could actually garner some interest. Finally, energy is an area that, of course, was the beloved sector last year that has been absolutely nowhere so far this year. That's a spot that, again, we think there is some dividend. There's some interest in returning cash to shareholders. And if we see a contraction in bond yields, we'd expect that energy could actually start to perform fairly well, including areas like midstream energy, which investors can certainly get some exposure to. So that we think is the next frontier for markets. Not so much what happens with tech. Again, we're constructive on tech. We actually think the next leg are some of these catch-up trades, mid-cap, small cap, real estate, as well as energy. Those are spots to pay attention to.
Eric, what about utilities as some of those inflationary pressures do I mean, they are easing right now. If they do continue to ease, could that provide a little bit of a catalyst there for that sector?
Shauna, it certainly could. It's a great business model. You're talking about regulated businesses that have, generally speaking, some level of inflation protection embedded in their pricing. That's something that again, even if inflation eases a bit, there's still the need for a hedge, if you will. And so utilities can provide some level of just inherent regulated pricing power in what they do. Again, they do return cash to shareholders, as you mentioned. And so one of the things that you were rightfully pointing out the prior segments is what's happening with interest rates. You know, we have to look at where yields are right now. They peaked above 4% last week, and a contraction in interest rates is very good for dividend paying entities. And that's true for utilities, it's true for infrastructure, true for energy as well. And so that could be another leg, if you will, to that stool with utilities. Again, not necessarily the most economically sensitive sector, but does provide some really nice cash cushion for investors. And as yields contract, certainly could get another part of that story as well.
Eric Friedman, U.S. Bank Asset Management Group CIO. It's good to talk to you. Really appreciate the time.
Thanks.
We are just getting started here on Yahoo Finance Live. Coming up, we continue to break down today's CPI data and what it means for the Fed ahead of their next meeting. Plus, Big Four accounting firm KPMG is making a multi-billion-dollar investment in Microsoft Cloud and AI services. We're going to speak with the U.S. Chair and CEO Paul Knupp later in the hour. And shares of Bitcoin and Coinbase rising over the last month on hopes the federal regulators approve the first ever ETF that holds Bitcoin. We're going to break down the latest in crypto in our 4 p.m. hour with Grayscale CEO Michael Sonnenschein. Stick around. Much more to come here on Yahoo Finance.
The cost of food is slowly coming down. Prices increased slightly in the month of June, rising 0.1% on a month-over-month basis, up 5.7% from a year ago. But where exactly are some of those increases coming from, and where are we seeing some price drops? Here to break it all down for us, Yahoo Finance's Brooke DePalma. Brooke, I guess some good news here within this report that shoppers are seeing some relief for items at the grocery store.
Yes, some relief. It's relatively flat. So month over month, prices are down 0.1%. But year over year, prices are still somewhat higher, but slowly decelerating, up now 4.7%. Now, the good news here is something that Yahoo Finance has been watching all year long is the price of eggs. They continue to see prices decline. They're down 7.3% month over month, down 7.9% year over year. And as you can see right here, for a dozen large grade A eggs, price now is $2.22. Now that's down from $4.82 earlier this year. Of course, eggs largely volatile, but certainly were influenced by the avian flu outbreak. And the good news continues. We have a few other foods where you can expect decreases next time you go to the food store. Pork, that includes roast steaks, as well as ribs, are seeing drop prices down there in that category, down 2.1%. Milk, lunch meats, fresh fruits also seeing a decrease there, and non-alcoholic beverages seeing a drop of 0.1%, but that was driven by instant coffee. So maybe Folgers next time you go into stores. That declined down 1.0% on a monthly basis. Now, some foods still seeing sticky inflation higher month over month. That includes uncooked ground beef as well as beef steaks, both up 1.6%. Tomatoes, also a largely volatile item that was definitely impacted by the California wet weather. Prices there up 4.6%. But in addition to that, we're also seeing processed foods, so cereal and bakery items, as well as candy and chewing gum also higher. And that candy and chewing gum up 2.2% month over month. That's the highest monthly jump since January of 2020. And so certainly something that's being impacted by wage costs, labor costs, transportation costs. And so those two categories seeing a higher jump there.
So, Brooke, what does this all mean in terms of outlook for consumers?
Yeah, well, consumers are certainly still feeling the brunt of inflation. And Yahoo Finance actually took to the streets just to hear where exactly they're feeling it, whether it's grocery prices or somewhere else. Take a listen here.
I would say like on daily basis, like groceries, basic services as like, internet or all those basic services. They have affected my family as a whole.
Produce is just off the charts. Like even having a salad every day is just getting to be kind of insane.
But, we've always been very careful with our money, and so we're good. I mean, maybe we're not eating out quite as much as we used to.
I think I'm feeling it the most in terms of like my daily expenses. If I go grocery shopping, my groceries I've noticed are definitely like $20, $30 more expensive.
And so certainly Americans feeling the impact at the grocery store. Other U.S. consumers that we took and spoke to on the streets in New York City told us that rent, transportation, the cost to commute to New York City also costing them higher. But as we heard there, salad costs, the cost to dine out up 0.4% month over month. But ultimately, these changes remain relatively flat. And so we'll just wait and see what happens this month.
We'll wait and see. And hopefully we start to see more significant improvement. All right, Brooke DePalma, thanks. Let's do a check on the markets here, sponsored by Tasty Trade. You're still looking at gains across the board. Stocks climbing on the heels of the CPI print this morning, showing a slowdown in inflation. The Dow up just over 100 points. S&P up about 0.8%. Taking a look at the sector action, 10 of the 11 S&P sectors here trading higher. Materials and utilities among the winners in today's action. Also taking a look at the VIX, the fear gauge index falling further here today, below 14 at 1376.
Well, as Brooke highlighted, the latest consumer price index data shows inflation eased to 3% in June, coming in below estimates. The same can be said when looking at core inflation, as the rise in June also came in lower than expected. Following the latest CPI print, our next guest says inflation at the retailer has come off full boil. Here to discuss this, bank rate senior economic analyst Mark Hamrick. Mark, is it safe to say we're in the final innings of this tightening cycle?
Of the Federal Reserve, yeah, I think so. We just don't know how long these innings are going to last. There could be a lot of people still coming up to bat. But obviously, with 500 basis points of tightening behind us and the Fed projecting no more than 50 basis points for the most part going forward, we may get 25 of those here at the end of the month. Obviously, that would suggest that we're in the final chapter of this part of the monetary policy story.
Mark, what more do you think the Fed needs to see in order for the Fed to be satisfied, for the Fed maybe to stop after this next rate hike later this month?
It's all about inflation, and really that it's as simple as that. I think that if we were to see further good news, perhaps in the forthcoming prints, not only in the PPI but the personal consumption expenditures, and then we'll get past the end of July FOMC meeting and then go through all that once again. I think also further moderation in hiring, as indicated in the June jobs report. That's the expectation. And you know, I think the problem is that whether you're looking at that core rate, which should not be dismissed, you know, that is the sticky part of all this, right? And so we know that services inflation is probably going to be more persistent as we, you know, go out into the future, and remains to be seen how much consumers give up the ghost, so to speak, with respect to their spending going forward.
So let's talk about that sticky part. I mean, what's it going to take to bring that down? As our guest earlier alluded to, going from 9 to 3%, not easy, but certainly points to progress. That last 1% is really the tricky part.
Mm-hmm. Part of it is demand, right? And so, you know, we, although it's, you know, sort of economics 101, just think about how much we've really had, you know, this imbalance between supply and demand going back to the very early days of the pandemic, supply chain disruptions, consumers wanting all kinds of things in a big way that maybe they didn't need or want in the past, part of that working and living from home. And now, of course, the demand for services, and part of that, of course, this summer has been demand for travel. And you know, so airlines are sort of basically saying, you know, we'll set our ticket prices where we want to, and hotel operators doing the same. And so it really does take some better balance between supply and demand. And obviously, if we were to see something more serious develop with respect to the economy, we just published our Bankrate quarterly economic survey, and economists still put the risk of recession at basically 50%, or basically the odds being 1 in 2 out over the next 12 months. I would also argue we've seen certain sectors of the economy acting recession-like or recessionary. But as we see that develop, and whether it develops in terms of an actual recession or not, I would expect that we'll see some more flattening in demand in the future, because let's think about the fact that you know, monetary policy does work with long and variable lags, as the saying goes. And so that means that all those 500 basis points have yet to really be fully felt in the economy. Obviously felt in some areas early on, but not fully felt everywhere.
So, Mark, if there's a 50% chance that you think we're going to see a recession, if the Fed does, in fact, hike 2 more times, what do you think then that the employment picture looks like over the next couple of months? Is it going to be able to stay relatively strong if we do see a more shallow recession?
Well, first of all, you know, I like to think about the fact of the 50-50 piece of that being the glass both full and half empty. And that means that it's not a certainty that we have a recession in the near intermediate term. And that means that there's also a decent chance of a soft landing. But to your question, it's absolutely the expectation here that we do see more moderation in hiring. And think about the fact that in that June jobs report, the private sector accounted for about 150,000 jobs. Government was 60. We won't expect 60,000 jobs from government each and every month. And so at that roughly 200,000 jobs added a month level, that's half the rate that we saw for all of last year on average. And so the previous level was unsustainable, and it's not being sustained. And so I would expect that we'll see some normalization, we may call it, in the job market, because, you know, we just got the beige book today setting up the next FOMC meeting, and you see a lot of references in there to the job market still being tight, some employers still having a hard time finding the workers they want. Many workers are being sort of retained by their employers because they don't want to be in the same spot that the employers were early in the pandemic, where they got rid of them and then all of a sudden had to bring people back, and then asking, of course, where are all the workers?
So, I mean, how do you marry what we're actually seeing in the data versus where the consumer sentiment is? You know, on the one hand, if you look at the progress we've made year on year, it's certainly significant. Prices are coming down. And yet there seems to be this overarching sentiment that things aren't necessarily getting better.
Well, they aren't. I mean, we're still higher over the past year, and we're significantly higher over the past 2 years. And so, yes, you look at areas that are the tremendous irritants like gasoline prices; those have obviously leveled out. Food prices are in the process of doing that. Shelter prices, meaning rents and home prices, still extremely elevated on balance. So it's not just the year-over-year change, it's the absolute level. And we may or may not see prices go back to where they were before. I would not really expect that to happen, but rather it's really the year-over-year change that everybody's targeting, and that includes the Federal Reserve.
Bankrate Senior Economic Analyst Mark Hamrick, good to talk to you today. Appreciate the time.
Thank you.
Well, the headline inflation reading was welcome news to investors, but digging a bit deeper into the data, it shows that location is key when it comes to price moves. Julie Hyman is here with a closer look. And Julie, taking a look at some of these numbers, it's clear that the pricing pressures is not even across the country.
No, it is not. I guess location doesn't just go for real estate. There's a pretty big gap here. In the Northeast, we saw the smallest increase in inflation year over year at just 2.2%. And then that ranges up to a high of about 3.5% in the Western region. Those are sort of the big regions that the BLS looks at when it is assessing these different pricing pressures. But then if you dig into specific cities, it is really disparate, the size of inflation that we are seeing. And that goes all the way from the highest inflation that we saw over the month in the Miami region. And it's not just Miami itself, it's Miami, Fort Lauderdale, West Palm, so really the whole southeastern Florida area with that 6.9% increase, Detroit, Michigan, and environs as well. Seattle, Washington, and again, that includes Tacoma, Bellevue, so sort of the bigger metropolitan area, and same goes for Atlanta, Georgia. So those were the areas that had the highest CPI on a city-specific basis. And then the lowest CPI, urban Alaska, go figure, actually saw a decrease in inflation, a decrease in prices, I should say, of 3.3%. Houston, Texas, that bigger area, the Baltimore, Maryland metropolitan area, and then San Francisco also seeing relatively small increases compared with overall, you guys.
So, Julie, what do you attribute that disparity to? Why are we seeing such a wide divide?
You know, I've been trying to sort of dig into this with economists since we got the numbers. There are a couple of different potential explanations. Part of it just has to do with economic growth, right? That we do see uneven GDP rates around the country. So prices are somewhat tied to that. That's what one economist floated to me. And then there are also specific things tied to insurance, particularly in areas like Florida. Our Rick Newman actually recently wrote about this issue specifically for Florida. If you look at the average insurance premium in Florida for homeowners, $6,000 per year this year, that compares with $1,700 nationwide. Now, some of that has to do with the climate of Florida. We're seeing that effect in places like California as well, that insurance premiums are going up because there is more climate-related damage that's been happening. Some of it is specific to Florida. There have been specific fraud instances there that have actually driven out some of the insurers who used to do business there. So that's kind of part of what's going on there. But there's definitely the bigger climate issue here that is pushing up insurance costs in some areas. It's unclear if that's sort of what's directly impacting the numbers for this month. That is a longer-term issue that is going to affect pricing pressures around the country. That's something Joe Brusuelos of RSM also highlighted when I was trying to dig into why we are seeing these differences.
A very important point to point out there. All right, Julie Hyman, thanks so much. Well, coming up, Big Four accounting firm KPMG making a multi-billion-dollar investment in Microsoft Cloud and AI services. We will speak with U.S. Chair and CEO Paul Knopf on the other side. KPMG is making a multi-billion-dollar investment in Microsoft Cloud and AI services. The commitment of at least $2 billion over the next 5 years is going to reshape professional services for KPMG and Microsoft in a number of areas. Here to talk a little bit more about it and what it's going to do for the business, we want to bring in Paul Knopf, KPMG U.S. Chair and CEO. Paul, it's great to see you. Thanks so much for coming in studio here.
Shauna, great to be here.
Well, congratulations on this investment. Certainly sounds like it's a massive step forward here for KPMG. When you're talking a multi-billion-dollar investment, why is AI, why was this investment right for your company?
Well, truly, generative AI is an emerging technology. If you think about late last year, it first came on the scene, and we needed a way to accelerate the development of that technology to bring it to our clients more quickly in the future. We saw that partnership with Microsoft as a perfect way. We've been in partnership with Microsoft since 2000, but this is an enhanced partnership. We will invest $2 billion over 5 years on solutions for our clients, but also to supercharge the experience of our employees that we have today, because they're going to be able to do things more creatively with these tools. So we're really excited about that. We think it will generate $12 billion of additional revenue over the next few years. That revenue will come from sources like cybersecurity solutions, from the migration to the cloud and inclusion or integration of generative AI into these cloud services, as well as innovative new applications that are not here yet, but we're currently working on.
Yeah, that $2 billion or $12 billion, I should say, value you pointed to, Paul, certainly significant. Can you be a little more specific on where you see the growth happening? How do you see this technology being deployed?
Sure, Kiko. We absolutely see it being deployed in almost every part of an organization, regardless of sector. So, for example, you can take this technology and you can embed it in sales and marketing. You can embed it in engineering, production, and finance. And you can make those operations more efficient and effective through the integration of this technology. It's also true to say that you can embed it in processes like tax. And we have KPMG Digital Gateway today, where we are working on upskilling that tool with generative AI. So there's almost no part of the organization that this would not touch. And it's really exciting for that reason.
And how are you communicating this to your employees? Because I think a lot of workers out there are a little bit nervous just about what AI is going to mean for their jobs. So I guess a two-part question here. How does it affect their day-to-day responsibilities? And do you see this affecting your headcount at all?
Sure. Well, if I look at the arc of recent history, the last 40 years, let's say, since I've been at KPMG, every major technology disruption that I have witnessed was not accompanied by significant loss of headcount. Because as we generate new economic activity and new ideas, we tend to need more people. And we see generative AI is the same. So what we're looking at is we need people to ensure it's safe, secure, and reliable. We need people to interpret the results of the generative AI, because it's neural networks and large language models that's giving us this, and they're not perfect either. And we're going to need people that are data scientists to help us gather the right kinds of data and interpret that data. And then, of course, we're going to need people to help us develop these solutions. So we believe that generative AI and the investments we're making with Microsoft are going to allow us to actually, over a period of time, increase headcount. But it will definitely,
when you think about...
Yeah, I'm sorry, Kiko. I was just going to say that it will definitely cause movement of certain activities, such as more routine activities, from people to technology, but that will allow us to upskill those people and have them do more value-added things.
Yeah, disruption, but not necessarily job loss,
Right.
it sounds like what
Absolutely.
you're pointing to. You touched on the security part of it a bit, and I wonder if you can elaborate on that, how you're thinking about the element of security, credibility. What are the safeguards you're considering, given that this technology is still in the very early phases?
Yeah, so we absolutely need to develop these tools and technologies in safe, secure environments. So for instance, when we use a ChatGPT type tool at KPMG, we're doing it on our secure platform with the enterprise security that Microsoft provides, and which is one other reason we really want to be in this partnership, because of their great technology. And so as we help clients develop these solutions, we're going to be looking at the governance around this technology, as well as the security that's built are architected around the technology, that's going to be a very important part of the development of this technology as we move forward into the future, ensuring that it's used in safe, secure environments and that it produces reliable, accurate information for companies to use.
Paul, in this type of uncertain environment, we got the inflation print out this morning showing that inflationary pressures are easing, but it's largely expected that the Fed's going to raise rates again later this month. Too early to tell what's going to happen later this year. How are you thinking about this as a CEO and evaluating investments and opportunities like this today, trying to figure out what makes sense and what doesn't in this environment?
Yeah, so as we look at this environment, we think you have to invest for the future. And we're going to invest in this arrangement with Microsoft, and we're going to invest in other generative AI and cloud-based technologies. So there's no doubt that at the current time, in the last few months, there's been more uncertainty. Some of that's caused not just by interest rate increases, but by tightening credit conditions that are providing a little less clarity about spending by companies and by consumers to some degree. And so you have to take that into account. But as I look at the longer term, so say beyond the next 3 to 9 months, the next 3 to 5 years, I'm really optimistic for a number of reasons. The type of technology we're talking about today and the spending on that technology, the Inflation Reduction Act and all the spending that's going to be happening around transition to cleaner sources of energy, the fact that there still is some structural imbalances in the labor market that are going to cause fairly tight conditions in the labor market. And then, very importantly, that trend of reshoring more because of supply chain risk, we expect that's going to continue to, and that will also provide a pillar of strength for the U.S. economy. So we think it's a very resilient, strong economy, but the next 3 to 6 to 9 months, there may be a little less clarity.
All right, well, Paul, it's great to see you. Thanks so much for coming in here in studio.
Thank you.
Paul Knapp, KPMG U.S. Chair and CEO.
Thank you so much.
Well, turning to politics now, at this point in the 2020 election, healthcare was at the forefront, at least among Democratic presidential candidates. This time around, Medicare appears to be a forgotten topic. At least that's how Rick Newman, our very own Rick Newman, I should say, puts it, breaks it down for us. Rick, we've got a long way to go, right? Why are we not hearing as much, though, about this very issue that really riled up the base in the last election?
Let me just take you back to where we were 4 years ago. Many people probably want to forget about this, but around this time in 2019, 15 months before the 2020 election, there was a debate with 10 Democratic candidates, and the dominant topic was Medicare for all. Should we have Medicare for all, a single giant program that covers everybody, or should we have some lesser reforms? Now, President Biden won. He favored smaller reforms, but fast forward to today, and you are hearing basically nothing about any kind of healthcare reforms. Nobody's talking about Medicare for all. Part of the reason for that is President Biden, since he's running for re-election as an incumbent, he's basically running unopposed. So there's no Bernie Sanders in the race, no Elizabeth Warren, no Cory Booker saying, oh, we need to run on this giant healthcare program, put everybody into Medicare. And Republicans basically have no healthcare plan at all. I mean, their only plan in recent memory was to repeal Obamacare. That failed spectacularly in 2017, and they're probably lucky it did because they didn't have a backup plan. They would just repealed it and thrown 30 million people off of insurance. So we're just not talking about healthcare reform at all in the 2024 election, and I'm not sure we ever will.
Well, Rick, one issue we certainly are hearing a heck of a lot about and something that voters are paying very close attention to, it's inflation. We are seeing some improvement with inflationary pressures easing, but we put up a poll from Yahoo Finance on Twitter here asking our audience, asking consumers whether or not they are feeling any improvement when they go to pay for goods and services. 71% are saying no. Obviously, inflationary pressure is a massive issue here for Biden as we look ahead to 2024. He has gotten a little bit more aggressive in terms of his messaging on the economy, but how big of a risk, a challenge is this for the administration as we do get closer and closer to voting day?
Well, for the last 2 years, I think inflation has been Biden's single biggest political and economic problem for obvious reasons. I mean, we had gas prices hitting $5. That just freaks people out and makes them feel like everything's wrong. We've got rents that are going up by more than earnings. Food prices have been going up by more than earnings. So that said, the trend is definitely going Biden's way. So inflation overall peaked at an annual rate of 9 or 9.1% last June. It's now down to 3%. If we just had 3% without 2 years of very high inflation, nobody would even really notice. The reason that people are still shell-shocked by inflation is that, we've had basically 2 years of run-ups in prices, and those increases are still there. So even though the rate of increase has come down by a lot, most prices are not falling. They're not going back to where they were, let's say, 2 years ago. But in the next year or so, we could see more prices actually turning around and starting to decline. We have seen a few things start to do that. Used cars is a good example. I mean, we saw astronomical inflation rates for used cars for about 6 months. And used car prices are now coming down, and economists think that that is going to continue. Rents are probably going to moderate. So Biden could end up being in pretty good shape on inflation a year from now. I mean, what really matters for 2024 is the condition of the economy about a year from now. Economists are predicting inflation in the range of 2.5%, maybe a little bit lower than that. So maybe by then, a year of moderating prices and people will start to feel better.
That's at least certainly what the administration is hoping. We've got a long way to go, though. Rick Newman, as always, thanks so much for that.
Bye, guys.
Well, coming up, we are checking in on a few tickers that you should be keeping an eye on and few to stay away from. Stay tuned.
The sharp rally in tech's biggest names spurring the Nasdaq to rebalance its Nasdaq 100 index. That's set to go into effect later this month. Jared Blickery is here with a closer look. So Jared, I guess break down how exactly this works and what it means for the market.
You bet. It's called a special rebalance, and I'm going to get to that in a second. I just want to show the outsized outperformance of the Magnificent Seven, as many are calling them. This is year to date. NVIDIA now up 200%, Meta up 150%. We've seen these numbers, so I want to focus on what's happening with the Nasdaq. Now, a week from this Friday, they are going to make something called a special rebalancing And this is triggered when the aggregate weight of companies that each have more than 4.5% weight in the index, that total weight tops 48%. So when we have those big companies like NVIDIA, Apple, Tesla that are making up a substantial part, they get too concentrated, and we've been talking about this for a while. There are automatic rules in the Nasdaq that have it rebalance, and this is to avoid an SEC conflict, to be in conflict with SEC rules. So Wells Fargo has done some of the work, and by the way, this happened in 2011. There was too much concentration back then, and what they discovered was in the 10 days leading up to that rebalance, the winners were actually the stocks that were going to be upsized, and the losers were those that were going to be downsized. And so that's kind of intuitive. Back then, guess what? Apple had to be downsized. It was too big. Very similar to this time around, but the other names, not as familiar. Qualcomm, Starbucks, Altera, Baidu, list goes on. Even Bed Bath & Beyond back then was too big to actually be included in the index at full weight. Microsoft had to be upsized, so did Alphabet, and so I think that's pretty interesting because both of those are getting downsized now. But nevertheless, when you take a look at what's happening over the last few days, this is I was showing the year to date first. I'm going to show you what happened over the last 3 days in the index. You can see not as much of an outperformance here. You see NVIDIA, Meta up 3%, 6%, Amazon up 1%, but we do see some losers there. Compare that to some of those names that Wells Fargo is going to be upsized, and you see a lot more outperformance here. So in the intervening 3 days since we got this announcement, it was after the bell on Friday, definitely seeing some interest in these stocks. Now, this is only a short-term punt, and there's no guarantees that this will continue. There's also no guarantees that these will be the exact stocks. This is only a guess by Wells Fargo as to what's going to happen. We'll find out that after the bell on Friday. But again, leading into July 24th, which is a Monday, we're probably going to see some more interest in these stocks and a little bit less in these, all things being equal, guys.
This is trying to bet on the next big winner. All right, Jared Blickery, thanks.
Well, the CPI data may have the markets moving today, but it's time to take a longer form look at the potential hot spots for investing in the second half of 2023. To give us his take on what stocks we should be buying right now and the ones to avoid, let's bring in Brian Mulberry, Client Portfolio Manager at Zacks Investment Management. We're going to start with your picks, what you like right now. Vail Resorts specifically, you're looking at the travel space right now. That stock not at the highs, still below the high of the year, but we have seen consumers, despite some headwinds and concerns about higher prices, shelling out on travel.
Yeah, absolutely. It's a way to access the consumer in a slightly different way, where we're seeing the revenge travel trade is still occurring. And what we're noticing about Vail in particular is that season pass sales are up about 6%, and they're having a really good recapture rate when it comes to renewing pass holders from last year. And on top of that, they've actually been able to increase prices. So actual sales in dollars are up 11% on that 6% higher season pass sales. So we're looking at a way to take advantage of the consumer spending that has been really durable over the last year. And that's one of the reasons we like Vail. Vail's also done a great job of providing a different menu of passes available and also different destinations. Now, international, we're seeing very strong demand for their resorts in Australia. And there's been some great cross-selling opportunities for consumers internationally to access the U.S. mountains and markets, and then obviously for U.S. consumers to travel abroad. And so we're definitely still seeing consumers spend money at a very high rate. And it's one of those ways that we can access this type of a stock at a good price that's still set to continue to grow.
But Brian, how should investors be looking at a name like this, given the fact that we are still at a risk of recession? There is some signs that the consumer is cracking just a little bit, pulling back on some of their spending. Is a name like Vail, is that going to be able to withstand some of that volatility?
We think it is, because there's definitely a big dividing line in the consumer right now. And it's simply this: if you owned your home during the pandemic, you had a once in a generation opportunity to refinance your biggest debt, which is usually your mortgage, on your biggest asset, your home, that appreciated probably 30 to 40% in value. You were able to pay off your cars, your student loans, all these other debts and credit cards, and you now have a much cleaner personal balance sheet. Your personal net income is probably in much better shape than it ever was before. And that lends a little bit more consistency to this consumer spending picture that we're seeing. Unfortunately, if you didn't own your home, those are definitely the consumers that are feeling the pinch of high inflation as well as high interest rates at this point in time. And so we're definitely keeping a close eye on it. We're aware of it, but there is a way to still bet on the consumer. And we think this is one of the ways to do that.
Another stock you're really hot on, CSX. This is in the rail space. What do you like there?
What we're seeing is just a really consistent level of volume in terms of the rail traffic that they have. They've actually been able to grow by almost 40% in terms of their coal transportation. A lot of that coal is going to produce electricity in other places. And so they've been able to keep up with a really high level of demand, and the execution in the transportation space is one of those things that leads to better margins overall. So again, not a huge valuation. It's one of those ways to invest in something that doesn't have a gigantic PE forward multiple, but also has really good durable earnings. They're also rewarding shareholders by raising their dividend. They actually increased their dividend by 10% earlier this year. And so it's a way to be a little bit more defensive in your allocation. But we also believe that energy overall might be a better place in the second half of the year. And this is just a different way to access those types of returns, looking at what we've seen in terms of the price of coal and now demand for it coming up. It's going to be a better back half of the year for these types of names, in our opinion.
Brian, one of the names that you're advising investors to stay away from is CVS. We know the stock has been under pressure now for some time, off pretty significantly since the start of the year. What do you see as pressuring the company here going forward?
Well, there's a couple of different reasons that we see, I think, a material decline in both profitability and overall earnings. And obviously, it's one being that they're not getting reimbursed for COVID testing and COVID vaccines at nearly the rate that they were a year or 2 years ago. But also, in addition to that, there's a lot of regulatory pressure on prices at pharmacies for drugs. And that's good for consumers, but it's net bad for the balance sheet for somebody like CVS when we're seeing more generic drugs available, but less reimbursement coming from distributing those generic drugs. It's kind of a double whammy on a company like CVS, where they're not getting the reimbursement from COVID protocols, and now there's pressure on prices at the pharmacy, which is normally, their top breadwinner, if you will, in terms of generating that revenue. So we think it's going to be a bit of a tough slog for CVS for the next couple of quarters until they can kind of get things figured out and where their margins might be headed.
Finally, Brian, you were talking about some opportunities in the energy space. This next name, not necessarily one that you would encourage investors to stay on top of. What are the concerns you have with First Energy?
First Energy kind of has an aging grid, if you will. This is a power utility. And while there is a lot of demand for electricity, the way that it's been generated has not been profitable for them. And unfortunately, it's a publicly traded utility that has price caps, if you will. They have to get permission in order to raise their rates to be more profitable in most of the markets that they serve. They've been having a difficult time accessing equipment, maintaining equipment, and like I said, their aging grid has really just been a drag on their overall profitability. So this is one of those energy type names that we would avoid because it just seems like their execution is a little bit behind the curve. But this is one of those things where certainly the supply chain has affected their ability to get the parts that they need to upgrade their grid and their distribution facilities for sure. But it's definitely weighing on their overall earnings and profitability picture. So this is a name that we would be cautious of in the next couple of quarters.
All right, Brian Mulberry of Zacks Investment Management. Thanks.
Thank you so much.
Well, the writer's strike in Hollywood, just hours away from potentially expanding to an actor's strike. The SAG-AFTRA union has been negotiating with movie studios for months. There's a deadline looming at midnight today. Yahoo Finance's Ali Canal following the details for us. Ali, if we see both of these unions strike, something we haven't seen in more than 60 years.
Yeah, it would be devastating to the LA economy, devastating to a lot of our favorite shows. And right now, there seems to be no end in sight to the writer's strike, and very likely that we're going to see SAG-AFTRA strike. They're currently in 11th hour negotiations with federal mediators. That was at the request from these studio heads, along with some of these major streaming companies that desperately want to try to avoid a double whammy strike. Now, in a statement, SAG said that it will not be manipulated by these big-time studios and that it wants to make sure all of its members receive a fair and equitable deal. One of the biggest sticking points here is AI. On the actor side, they believe their image, their likeliness, their voice is going to be sold off. And then on the studio side, they want to be careful that they're not setting a game-changing precedent in these deals when it comes to AI and the potential that it could have, especially since the technology is very new. So AI, a big factor in these ongoing talks. Another issue continues to be streaming residuals, how these actors get paid in this new age media environment. That's something that the WGA is fighting for as well. So a lot of issues on the table here. SAG-AFTRA already extended those contract negotiation deadlines by a week. It's very unlikely they're going to extend that once again. The deadline is midnight tonight, specific time. And if we don't reach a deal, those actors are joining the writers on the picket line. WGA has just completed its 71st day of striking. And again, no end in sight. Deadline is reporting that studios really aren't willing to negotiate with the WGA until possibly the fall. So we might not even see a resolution to this to closer to Halloween time, which is just so crazy to think about. And obviously, Kiko, I know you're out in LA too and have spoken to a lot of these writers, and it's really devastating to see what's happening right now. And you hope that both sides can reach an agreement at some point.
Yeah, a lot of businesses hoping for some kind of resolution as well. They've been hit really hard. Well, I'll be watching to see if there is some kind of resolution by midnight tonight. Ali Canal, thanks so much for that. Well, coming up, the closing bell on Wall Street. We're checking in on the latest market moves and the top trending tickers. We'll be right back.
And that's the closing bell on Wall Street. Let's do a check of the markets sponsored by Tasty Trade. All three of the major averages ending to the upside today. The Dow off its highs of the day, but still closing in the green. Then S&P up just about 0.7%. The Nasdaq up just over 1%. The market moving higher following that inflation print that we got this morning, pointed to pricing pressures easing. All right, let's take a look at some of the big movers of the day. First up, Palo Alto shares under pressure in today's trading session amid new competition from Microsoft. The tech giant is expanding in cybersecurity after introducing products under its, quote, secure service edge umbrella. And Kiko, when we take into account some of the nervousness that we are seeing from the reaction in shares today, I think analysts, investors are trying to figure out what exactly Microsoft's push into this space, what it's going to do for some of the leaders who have historically been able to really find and make their own footprint within cybersecurity.
Yeah, and we're talking about Palo Alto right now, but their competitors also down today, Cloudflare as well as Zscaler. This is still in the very early phases. There's no pricing details that have been offered from Microsoft. But as we know, Microsoft is a huge enterprise play. I mean, you could argue, Shana, though, that there's enough to go around, right? I mean, if we're talking security, I mean, that is something that we have heard over and over, not just from these companies, but from analysts as well, that the demand is there. And this is an area that a lot of companies are investing in. So we'll be watching for any of those additional details coming out of Microsoft to see how it threatens some of those names that we just mentioned. Well, DraftKings shares rising after the company received a bullish call from an analyst at Bank of America, upgrading the stock from neutral to buy. This is one of those stocks that have seen huge run up of more than 150%. And I go back to a conversation we had a few months ago, Shana, where we were talking about the potential for DraftKings to really be on this path to profitability this year. This is something that the company has already mentioned. But what will be those key catalysts? North Carolina most recently becoming the 28th state to legalize sports betting. But you have to wonder how many of these markets are big enough to really lift and drive that revenue for DraftKings.
Yeah, what exactly that upside potential looks like, at least in the near term. But this run up since the start of the year has certainly been amazing. And I think it caught a lot of investors off guard, a lot of analysts off guard. And that's why we're seeing this catch up here with so many analysts, because Bank of America is not the only name on the street here that is getting a little bit more bullish when it comes to DraftKings. I think a lot of the expectations going into these second quarter earnings are a bit low given the performance that we have seen since the start of the year. We know that DraftKings has been able to gain some market share here from FanDuel, the industry leader. But I think really trying to figure out what exactly that potential looks like is something that everyone is having a little bit of difficulty with right now.
Yeah, I should point out BofA also upping its price target from $25 a share to $35. So a little more upside than where it's trading at right now. Well, shares of Lucid falling today, down nearly 12% there after its second quarter deliveries fell short of expectations. Yahoo Finance's Pras Subramanian with us now to break down the numbers for us. And Pras, what happened?
Yeah, so Lucid reported today around 1,400 deliveries for Q2. The street was looking for around 1,873, according to Bloomberg estimates. So a big miss there. The company produced around 2,200 vehicles for the quarter, which is also sort of below its Q1 performance. So kind of miss on both the production deliveries from the prior quarter. So not exactly good news for investors. Now, Lucid also said that it began material shipments of its EVs to Saudi Arabia, which is important because they have a deal with the government there to deliver about 100,000 EVs over the next 5 years or so. Important to remember that the Saudi Sovereign Investment Fund, the public investment fund, actually has a stake, a rather large stake, the biggest stake in the company right now. So that's going on right now. But Lucid also, not all bad news for them in the Q2. They signed a technology deal with Aston Martin to provide technology and materials and also sort of EV powertrains for Aston Martin's future EV. So that's a good news in terms of licensing technology. It's a big growth driver potentially for the company that sort of is hemorrhaging cash these days. But finally, we're going to hear more about the company standing there with Q2 earnings coming out on August 7th.
Okay, Pras Subramanian with those numbers coming out of Lucid. Thanks so much.
All right, Bitcoin has soared over the last month on hopes that regulators are going to finally approve a spot Bitcoin ETF. We're looking at gains of just about almost 17% in the price of Bitcoin, getting a boost after BlackRock filed paperwork with the SEC last month, sparking a new wave of optimism, and several institutions followed. Well, Grayscale has been trying to get approval for a spot market ETF since 2016. Its last request was denied. Now the company is calling out the SEC. For more on this, we want to bring in Michael Sonnenschein, Grayscale Investments CEO. Michael, it's great to see you. And I want to bring up the letter that you recently sent. And we have a full screen here to show exactly what you are laying out. You sent a letter to the D.C. Court of Appeals questioning the SEC's decision to approve a leveraged Bitcoin future ETF after previously denying a spot Bitcoin ETF. So lay out your case here and why these two decisions don't add up.
Absolutely. Well, it's great to be back on the show. I would say that this really comes down to the core argument. When the SEC denied our application to convert GBTC into an ETF, we immediately filed a lawsuit challenging that decision. And the argument that really underpins that is that the SEC has approved not one, but several Bitcoin futures-based ETFs, right? Futures are a derivative of that underlying spot market, but continued to deny, including GBTC, spot Bitcoin applications from coming to market. And those arguments were presented to the court. You know, we believe that they're common sense and compelling arguments, but the SEC now has gone on and continued to even go further into this arbitrary behavior by now approving a leveraged Bitcoin futures ETF, which in the actual prospectus itself outlines that that's an even riskier product, right? And so we do feel here that investors should have choice, right? They should be able to use Bitcoin futures ETFs, they should be able to use spot Bitcoin ETFs, really whatever's going to fit their mandate as an investor.
Michael, why do you think the SEC has been so reluctant? I mean, what's your read on what is driving or what's motivating the SEC to put the brake?
Well, I can really only point to what they've said in their denials, right? The SEC has been looking for a market that is surveillable, a market that maybe has the qualities and characteristics of other markets that they're used to seeing. That being said, you know, there are new conversations being had around surveillance sharing agreements and other types of constructs that maybe the SEC will be persuaded by, but time, I think, will tell.
Michael, many, though, are looking at the approval of the leveraged Bitcoin futures ETF as a positive step forward, given the fact that then maybe this makes it a little bit more likely that the SEC is going to approve a Bitcoin spot ETF. Do you share in that view?
Well, I think there's been a recent wave of ETF applications that have come in, and part of that optimism really does revolve around the GBTC lawsuit. We've been transparent with the market that we expect a decision from the court sometime, could be as soon as over the next few weeks, but probably by the fall, the latest. And so there's a lot of issuers that have been looking at not only has GBTC kind of laid the groundwork and become a place where many investors have gotten their Bitcoin exposure, but it's now the framework upon which they're basing their operations, their disclosure, et cetera. So they believe that that, in fact, could be a catalyst if a favorable outcome is reached there. And it continues to show that, you know, investor interest and appetite for this asset class isn't going away. And the continuation of Bitcoin futures, Bitcoin levered futures ETFs, these are all additional access points that investors now have.
Michael, it's been, more than 8 months now since we saw really just the collapse of FTX. And there were a lot of concerns, conversations around that time about what the future of crypto will look like. I mean, you've got institutional names now trying to get in with a spot Bitcoin ETF. I realize the opportunity is there as well. But what do you think has evolved in the thinking within the crypto space? And does that ultimately strengthen the case for investment into something like Bitcoin?
You know, it's great to think about that timeline in perspective, because you're right. It was only, 6-8 months ago that the narrative around crypto was that it was being left for dead, or it was a passing fad, or investors were fleeing it. And what we've said is it's actually quite the opposite. You know, this is my and Grayscale's third crypto winter, and we've continued to reiterate it's a great time to build, and it's a time when, crypto gets challenged and really demonstrates its resiliency. And so you've seen continued optimism, additional, institutional investors coming to the space, and assets like Bitcoin are some of the highest returning assets of the year. And so it really does show the staying power of the asset class, and that additional narrative from some of these incumbent legacy financial institutions is a really important construct for investors to keep in mind as well.
Michael, if we do see the approval of a Bitcoin spot ETF, how much of is that a game changer here for the industry, just in terms of wider adoption? And given the fact that many investors, you would think, want maybe some exposure to crypto, but they're more comfortable going that ETF route.
Exactly. I think the ETF wrapper is a tried and true product model that investors are used to for commodities, segments of the market, et cetera. And I think all of the issuers filing know there's a lot of pent-up demand. And so whether you're looking at GBTC or any of the other products looking to come to market, there are trillions of dollars on the sideline, even just in the financial advisor market, that are looking for a convenient solution to give their clients exposure to Bitcoin. So we do think it could be a material moment for Bitcoin, to say the least.
Okay, to be continued there. Grayscale Investments CEO Michael Sonnensheim, good to have you on today.
Thank you.
Well, coming up, Activision Blizzard shares giving back some of their gains today after a federal judge rejected the FTC's bid to temporarily halt that acquisition of the video game company. We're going to break down what's next for the deal and if more mega deals are on the horizon. Stick around.
The latest inflation data revealing a cooling in the housing market, but prices are still too high for many Americans. Here to explain the latest numbers and what's ahead for the rental market, Yahoo Finance's Rebecca Chen. Rebecca, in this report, we are seeing costs moderate just a bit, but they're still very high for so many people out there who are trying to rent their homes.
Yes, that's correct, Shada. So what we're seeing from this morning's inflation number is that housing inflation has definitely been cooling down. But what that means really is prices are still growing, but at a way moderate level that we have seen in the past 2 years. The inflation data shows that the housing inflation is about 0.4. And this is sort of a good news, bad news. The overall inflation compared to last month was 0.2. So we are still higher than what we're seeing for the general number, but it is coming down from last month. So again, we are saying that this is sort of prices are coming down, but it is not coming down enough. And one thing that we always pay attention to is the rental inflation. In this month, it was 0.5 compared to last month. And what that really means is rent could be stabilizing for the time being, and that is what the data are showing. And what the experts have been saying is that this is the slowest gain in the last 7 months. So we are seeing some kind of relief coming for the renter, but we are definitely everybody is hoping for more relief if you're looking on the market for a house.
Rebecca, we've been talking so much about the new construction that's coming online because of the lack of inventory. How's that likely to improve prices?
The new construction that are coming online, while it does give a little bit more supply on the market, but what the problem with new construction is that a lot of those are luxury apartments. What that means is these are the apartments that's going to ask for premium rents from their renters. So in terms of affordability, they're not exactly affordable for everybody, but it does sort of give a little bit more supply on the market, and that will bring down prices a little bit in the future.
Becca, when we talk about everything that's going on with affordability right now, where people can spend, where they can't spend, what are you seeing just on a regional basis? And when we talk about new homes, new home construction, just how much that maybe will alleviate some of the pressures and the affordability issues that we have seen?
That's a great question, Shada. What we are seeing in terms of region is that the West prices are coming down. And the Northeast prices are still fairly moderate and going up a little bit, and places in the Southeast, such as Florida and North Carolina, these places are definitely seeing a little bit more of a pricing crunch. So in terms of affordability, we are seeing more constructions that are coming online for different cities, especially the pandemic boomtowns that were extremely popular 2 years ago, like Austin. So we are expecting these places where a lot of constructions are coming online, the prices to pull back on them. But other places, areas where both prices and construction are still seeing a little bit of a crunch, renters and buyers might still have a struggling issue with affordability there.
Rebecca Chen, thanks so much for that. Well, let's do a quick check of the market sponsored by Tasty Trade. We saw all three majors closing firmly in the green today as investors responded to the cooler than expected CPI print. You see the Dow closing up 86, the S&P 500 up 32, and the Nasdaq up 158 with some big gains there, especially in the tech space.
All right, the pending $69 billion deal between Microsoft and Activision getting a big boost yesterday, but still needs to clear another hurdle. That is the UK competition regulators in order to complete the deal by July 18th, the deadline. For more on the latest, I want to bring in Brent Thill, Jefferies' senior analyst. Brent, obviously this news here yesterday, great news, a big win for Microsoft. My question, though, is what this means for the broader tech landscape and some of the deal activity that we could see as a result of this ruling.
We think it opens the floodgates for more M&A. There's no question that anyone that was looking at doing M&A was looking at the Microsoft transaction with Activision. They were looking at Broadcom, VMware. They're looking at Adobe, Figma. All these deals are in a holding pattern. And if we can get these deals closed, we think ultimately it's just going to open up more confidence to make the move forward. So good news, I think, is starting to prevail that ultimately, if it's good for the consumer, the government can't just block everything. And right now the government's been in a block everything. And as we've said repeatedly, in many of these examples, these deals are actually good for consumers. They're good for pricing. They're good for choice. And ultimately, as long as the consumer's not hurt, the government can't take a stance of it's bad for everyone. It's not a good stance. And that's been the stance that's been taken, which is block everything. And so every investor's like, look, nothing's ever going to get done again. That doesn't make any sense. It's not good for the economy. It's not good for consumers. It's not good for everything. Certainly, we're okay for deals getting blocked when they're not going to be good for the end markets. But in these situations, I think everyone was scratching their head how the government was gonna have a block on all these transactions. So certainly don't expect everything's gonna fly through. There's going to be ongoing scrutiny. There's going to be other scrutiny outside the United States that these companies have to go through. But For us, the overall sign is this is going to be a really good thing. And M&A is a good cleansing process. We've gone through a huge cycle where a lot of companies have gone public. A lot of companies are operating, and they just would be stronger together. And so I think this is a cleanse process we need to go through, and it helps restore confidence back into tech as well for a lot of other names.
With that said, Brent, what are some areas within tech that you think are particularly ripe for M&A?
Well, I think if you look at in every one of these segments, you look at applications, you look at infrastructure software, you look at cybersecurity. I think that the new big one that we're starting to see is an AI. There are a lot of AI startups. They'll never get scale on their own. They need big balance sheets and users and data to get the scale. So we've seen actually some pretty interesting M&A deals in AI in just the last couple of weeks. And I think that will continue. So what I say is I think it's across the board. And if you look at, again, the deals that are out there, one's in gaming, one's in infrastructure, VMware, Broadcom. When you look at the Figma transaction and collaboration applications, I mean, they're kind of cutting across different segments. I think we're going to see it across all these end segments. I don't think there's one area that jumps out to us. I think there's kind of multiple areas of the tech stack that will get consolidated. Many of these areas will benefit from M&A returning.
But when it comes to this deal, Microsoft buying Activision, the fact that it looks like it is on track here, it is going to go through, it is going to close here potentially by that July 18th deadline. What does that then do to other players that are already within the gaming space? Meaning, I guess, how big of an advantage maybe does Microsoft and Activision have against the other names that maybe aren't as well positioned given this tie-up, like a EA, for example?
Yeah. I'm not the gaming analyst, but what I can see, at least out of my own kids' behavior, is it's not riding on one vendor. Their love and gamers' loves for content is spread all over. They could be small publishers, large publishers. So I don't think that there's a huge disadvantage if this goes through and it's going to be harder for others, a huge advantage. I think ultimately those that have the most creative content, they're coming from upstarts and they're coming from other companies outside. I mean, if you look at the success of some of these other games like Fortnite, I mean, again, they're not coming from some of the core. They're coming outside Microsoft and others. So I think right now we're in a situation, again, when I talked about this earlier, we're in this natural cycle of consolidation. You're going to go through consolidation of the old school, but then it's going to spawn new companies. It's going to give room for new innovation, and those titles will come out of nowhere. You know, again, much like what we saw with AI, no one anticipated OpenAI to come with ChatGPT. Everyone thought that will come from Amazon, Google, or Microsoft, and it didn't come from any of them. It came from their own initiative, right? So my sense is that we're gonna start the cycle over again, and there's going to be excitement and independent platforms that really thrive, and that's been the case in a lot of the gaming companies for the last couple decades.
Brent, I know you've had strong thoughts about Twitter pre and post Elon Musk in the past. Now you've got Threads threatening potentially Twitter. At least we have seen that it's the most downloaded app, more than 100 million users. How do you think we should look at Threads in the context of Meta? Is this just an opportunistic play that will sort of drive incremental revenue with advertisers looking for a place, or is this going to be a bigger chunk of the business? Is that the ambition or the vision for Meta?
Well, I think, look, it's really exciting, and the pace of adoption is insane. I think it also speaks to Twitter, and I've said this repeatedly, really has a terrible user interface, and it's really hard to navigate the content, and there's a lot of stuff you don't want to see. And so ultimately, I think good for Meta and for Zuck taking on what has been a company that's really kind of had the platform out there with Twitter. I mean, it's just not usable for a lot of us that use it. It's hard. And so I think they can make it cleaner, more fun, and exciting, and it's part of your social graph. So you're going to learn more about what you actually want to learn about versus seeing pop-up ads for things you don't really even care about. And so I think this is right now it's really too early to make the call on monetization. We know the users are there. They're not providing advertisement on that platform yet. They will build the overall platform out and then add advertising. I think they're going to be super successful. Everyone counted out Reels. Oh, TikTok's going to kill them. You know, it's over. And look at what's happened with Reels. Look at what's happened in other areas where everyone counted Meta out. And we think you never want to count them out given their scale and their scope of the billions of users across the planet. So we think it's going to be successful. I don't know when that starts to turn on because it's still really early, but we know that they will monetize this, and I'm sure advertisers are licking their chops. When you look at the number of celebrities, creative types, you look at the activity, the number of users that are already on the platform, I'm sure the advertisers are lining up outside. They're gonna have a big line to let those advertisers in when they make the call and are ready to go. So I've said this for years. Twitter needed some competition, and I think they finally got it here.
Maybe not exactly what they wanted to see. More than 100 million users here on Threads in less than a week. Certainly a very impressive milestone. All right, Brent Thill of Jefferies, thanks for your time.
Thank you.
Well, coming up, we are diving into some of today's top trending stories. Josh Schaefer, Ali Canal standing by with what's on deck, guys.
Hey, Shauna. Well, you know what they say, time is money. And do you ever feel like you're wasting a heck of a lot of both when you're in a meeting?
I definitely do, and one company is going to tell you how much those meetings might be costing the company when you're sitting in there. We'll have that for you next.
Welcome back to Yahoo Finance Lab. We're talking about some trending stories today. I'm looking at a shocker in the food space. Domino's teaming up with Uber Eats, of all partners here, looking to get into the third-party delivery game. Now, this is different. It's interesting because Domino's has traditionally been kind of reliant on their own services. First time here going with third-party delivery service with Uber Eats, going to be their exclusive delivery partner starting at the end of this year and then through 2024. Now, a couple changes here. You can actually use the Domino's tracker in the Uber Eats app, so people will get used to that. And the people delivering the pizzas will actually be wearing Domino's delivery outfits. So thought that was a little interesting. But anyway, kind of funny that they're doing that now. I think it's kind of weird because they're still using the Domino's delivery people, but using the kind of logistics app for Uber.
You can feel the friction, right? That Domino's doesn't want to fully give away what has been a traditionally strong part of their business, right? I think a lot of people know Domino's for delivery, right? They know them for that old 30-minute, what was the 30-minute limit they had at one point? If they didn't come in 30 minutes, you get your pizza free or whatever the deal was. But for me, I think this is a massive move for Domino's in the sense of, I'll play the Gen Z card here. A lot of my friends either have never called in a pizza or didn't spend a lot of years calling in a pizza before we got smartphones and we ordered on apps. And the way I use apps here in New York City and a lot of my friends use apps is you just go on the Uber Eats app to look for something to eat rather than seeking out a restaurant.
Josh, there's a Domino's app.
Right, but you go on Uber Eats.
Can't even see
you
it.
go on Uber Eats.
I need to update it.
Yeah, it's not updated, so you haven't used it in a while.
Well,
and
I do use it though.
But you DoorDash, don't you?
I don't DoorDash Domino's. I go right through the app. Well, yes. But what I'm saying,
That's my point.
My argument is that it's very easy to use a Domino's app. You can see where it's going. You get those loyalty points. I just feel like I understand why they were hesitant, because sometimes with Uber Eats and some of these third-party delivery services, your food can come cold, it can come late. They had control over all of that. And it showed in their earnings, and it showed in the results that they had.
I think if you want to build your customer base, though, you have to get beyond your own app right now. Because your own app...
There's a reason why they're doing
this.
Yes.
If you only have your own app, only people that have had Domino's Pizza are likely to download that app, right? When you get on Uber Eats, someone can find a deal that they didn't know existed and get attracted to Domino's, which I think is a good part of this partnership.
Apparently, Domino's is losing out in the delivery game, losing actually fewer deliveries quarter over quarter, and then they saw Papa John's kind of seeing more deliveries with third-party apps, so they had to kind of go in there and meet them where they're at. But I think the issue also is that you're getting less money from your deliveries if you're going third party. So how do you make that up? So maybe they'll offer people like Allie some deals on those pizzas.
I hope so. I love Domino's, and I'm a big fan of them. But someone who probably doesn't eat as much Domino's as I, especially in my college years, is Kim Kardashian. And she is in the news today because she reportedly wants to buy back the minority stake that Coty purchased in her beauty brand about 3 years ago. Now, Coty completed a $200 million purchase for a 20% stake in Kardashian's company, formerly known as KKW Beauty, in January of 2021. Since then, Kardashian has rebranded to Skin by Kim, a luxury skincare line. The Journal saying that she wants to expand the company into other beauty categories, which is one of the reasons why she wants to repurchase this stake. Also, Jefferies is reporting or saying in a note following this report that it probably would sell for less than what Coty bought it for. So in a sense, Kardashian could buy it cheaper.
Yeah, so is she seeing a kind of a deal here, like saying that, you know what, I sold high, I can buy back low? Because I wasn't sure why she wanted to get that money, or why she wanted to spend the money to give it back to Coty. And maybe there was a deal where Coty could kind of block her expansion plans. I'm not sure, because she wanted to expand the skincare or the beauty product line. So I'm not sure what's going on there, but I thought it was kind of interesting that she wants to go back and give them back the money to get that piece.
Because it would be the most billionaire thing ever, right, Pras? If I lent someone the business I created, 20% of it for 3 years, they pay me, and then I buy it back for cheaper, and I actually made money on the deal while Coty helped me build up my brand. And that, like, just come on.
Yeah.
They always win. That's my takeaway from this, is they always win. If that's actually what happens and Kim Kardashian is able to buy this back for less money, beautiful. You take that deal 10 times out of 10.
It's shocking to me. I mean, I'm not sure. But I mean, also, Control, they mentioned this with the Sky Partners, her VC fund or private equity fund, staffing up hardcore. No purchases yet. Is this the first purchase?
That is a very good point, and something I actually thought of. Like, who knows? Maybe that is what she's planning. And Kardashian, look, she's a very shrewd businesswoman. She knows what she's doing. She has a lot of really successful brands. Skims, it's a very popular one that my friends love. Really, I know every single female friend of mine has something that is from the Skims line, and that has a really high valuation. She's a billionaire in her own right. She has the VC fund. Also, the Kardashians, which recently launched on Hulu, that's entering a few seasons there. Those are residual income, so she's doing well, making a lot of money. So there has to be a reason for this.
Kim Kardashian, a queen business operator. I would love to get her take on how she runs a meeting, but does she have one? I want to focus in on what Shopify is doing with meetings, though, because I do think this is interesting. So Shopify coming out with a new meeting cost calculator and essentially calculating how much the company is losing based on how many people are in a meeting and how long the meeting is. So part of this calculator shows that if it's a 30-minute meeting and there's 3 employees in that meeting can cost Shopify anywhere from $700 to $1,600. Now, when you add in an executive into that meeting, so now you have 3 employees and an exec for 30 minutes, that's costing Shopify more than $2,000 to run this meeting. And it's getting into the are there too many meetings discussion? Are these meetings valuable? I see Prosh shaking his head. He looks like he doesn't want to be in a meeting.
Yeah, no, I love this idea. I think it's fantastic. People are inundated with meetings. It kind of just you get just knocked out by meeting after meeting. It can't get work done. This is a fantastic idea. Show the true cost of what's going on here from a time point of view. I mean, people like Elon Musk, he would walk out of a meeting if he didn't think it was productive. Jeff Bezos has a 2 pizza rule, right? Where essentially, if there are more people than 2 pies could feed, meeting's too big, it's not going to be efficient. What are we doing here? And this is another way of kind of showing that why are we being so inefficient with meetings? Kind of like. It's just too much. I think it's too much. I'm going on the soapbox here. I love this idea by Shopify.
I love it too because it places a value on the meeting as well, right? If you're seeing this meeting is costing the company upwards of $2,000 or more, you better make sure that you come out of that meeting learning something or knowing something or developing some sort of strategy and having a solution for why this meeting happened in the first place. And I think everyone in the corporate world is in agreement that by and large, there's too many meetings. But I do think more recently, companies are trying to correct that narrative. And it's because of executives like Elon Musk kind of setting a new precedent for what meetings could and should potentially look like.
And I think it's interesting, though, too, when I love seeing things like this where you can kind of, in a box, it still doesn't quite make sense, right? Where one meeting is probably more valuable than another meeting. And I'm curious how, if other companies were to adopt this strategy and actually have a calculator, how do you add in that variable, right? For instance, a live television show has a morning meeting every day.
Right, that's
every day. That probably has 10
valuable.
people in it, and you probably have to have it. But when you use a calculator, that's very expensive. So how do you sort of parse through what is worth it and what is not worth it based on what's happening in the meeting? Feels like a pretty big variable here, when people might right now just be looking at that bottom line number and being like, they told me not to spend $2,000 on a meeting and I'm doing it.
I think it's what comes out of the meeting, right?
Yeah.
Like at the morning show meeting, you get a lot out of that. So that's worth that amount of money.
Right.
Other types of meetings you leave being like, that could have been an email.
Maybe in the margins you can say, do I need this status update? Do I need to talk about our KPIs? Like, do we need that stuff? So I think you're right. Like a morning show meeting, sure. But late afternoon, want to get some work done? I don't think so.
Yeah.
That's it for our meeting discussion. But one meeting I would have been fascinated to hear about is about this product we're going to talk about next. Up next, we're talking about Chipotle's new product that is mashing up guacamole at a pace you've probably never seen before. Next. really fired up for earnings season to start too. We have bank earnings on Friday, and then you also have Delta reporting on Thursday, and Pepsi also expected to report on Thursday. But I think a key theme when you think about this week is really what have the interest rate hikes started to do to the economy?
I could see some earnings weakness across the board. I think you're going to see a little bit of tentativeness from companies about consumers. I think it's going to be a story about the U.S. consumer, what's going on there, and global growth. Go back, say, 6 months to a year. If you talked about your supply chains being okay, that was enough. Now it's not about supply chains. It's now, are you able to sell your products, and at what margin are you able to sell those products?
There is not going to be any year-over-year sales growth for the S&P 500. That would be the first time that has happened in the past 10 quarters. So not every company's like NVIDIA. Not everybody's selling AI chips.
Goldman Sachs is saying now the key areas that investors will be watching for is maintaining margins, trying to push sales for profits, the impact of bank stresses and credit lending, the potential uses of AI, and also the health of the consumer, how much the consumer is willing to spend.
When all of these companies more broadly talk about earnings, especially within that airline travel experience, we're marching towards some of those key time frames for a company in Delta and many of the others in trying to get back to that full capacity. We've heard from Ed Bastian time and time again that this is the year.
If we look at big banks and even the broader financial sector, they haven't really participated as much in the year-to-date rally, with earnings kind of expectations already being low. It's a sector we like. It's a sector we've been overweight most of the year.
I think it's going to be, not bank's finest hour in terms of earnings this quarter. Clearly, the higher rate environment that was very helpful in 2022 for net interest margins is having a detrimental effect now. You've got slowing loan growth, just less demand as you have much higher interest rates here, and that's the intended effect of the Federal Reserve.
The CPI report showed some improvement on inflation. That's one of the Fed's mandates. For a look at where things stand on the other mandate, the labor market, LinkedIn is out with its June workforce report, and it shows hiring is down 2% from the prior month. Joining us now is Guy Berger, LinkedIn principal economist. Guy, let's talk about where the jobs are being created. It's interesting to see how it differs regionally.
Yeah, absolutely. I think what's interesting is that, for example, the West Coast areas are so dependent on tech, have been particularly hard hit. The other parts in the Southeast, Midwest, Northeast have been more resilient. And I think what's interesting more recently is we've seen hiring declines moderate and hiring levels stabilize. Is a lot of the cities where it's stabilized the most is actually the Northeast, where we're seeing some tentative signs of maybe even green shoots and hiring starting to maybe pick right back up.
Guy, what do you attribute that to? Why are we seeing strength there as opposed to other areas of the country?
I think it's a really interesting question. I think that essentially we saw a really broad-based pullback. I mean, we know that some sectors like tech and professional services saw a particularly sharp pullback in hiring late last year. But, a lot of those sectors are reverting to the mean. I think that a lot of the bad news has been baked in. A lot of employers are sort of looking at the big picture and saying, you know what? I've seen a lot of bad news about, the demand slowing, but maybe it's not slowing any further. Before I cut back on hiring, before I, for example, lay off more than my workforce, I want to take a look and see maybe we've sort of reached the low point here. And I think that's driving a stabilization, particularly in areas that aren't as exposed to the hardest hit sectors. That creates more room for stabilization, maybe upside.
So if this is the low point, I mean, does that suggest that we are headed towards what some have described as sort of that perfect scenario, which is a soft landing?
I mean, I think it's definitely possible. I think that it's certainly conceivable we get some bad news we're not anticipating, and that leads employers to become cautious again, start pulling back and cutting back on hiring. But if we don't, and if inflation keeps gradually coming down in a way that I think a lot of us have been pleasantly surprised by over the last 6 months, then it definitely creates room. The labor market's been so resilient, it buys us the time to let inflation gradually glide down. And we've been really lucky in that respect.
Guy, what are you seeing just in terms of the quit rate? Because when you take a look at the government statistics, it looks like that quit rate has steadily been falling. That quitting boom that we had seen play out during the pandemic, post-pandemic, is that over?
Yeah, so it is over in the sense that we have this once in a lifetime strength in the labor market seen both in hiring and quits, in wage growth that is way hotter than most of us have seen while we've been employed. And I think what we're back to is something that looks a lot like the late 2010s, which were a very good job market. People then were talking about things were good. We were starting to see wage growth creep back up. We're back there. And I think it is a little jarring because we're coming off from the extreme heat, but things are still pretty good. And so when you look at our data, one thing we've been following is this short tenure rate. People quitting their jobs within a year of starting them. And we've seen that come down. It's done year over year. So we are moving off of the extreme heat, but like by the standards of the last 30 years, and we've seen some bad job markets, this one is definitely toward the end of a pretty strong one, just not once in a lifetime strong.
Guy, when you look at the jobs that are being created, what does that tell you about what companies are prioritizing in a tougher economic environment?
Well, that's a great question. I think what's striking to me is that there are a lot of sectors we see that have been more resilient in terms of hiring, like education, the government, consumer services, and these sectors are seeing some of these other sectors slowing down as an opportunity to hire talent that maybe they were priced out of before in terms of, you can compete with, for example, certain kinds of machine learning engineers with those companies. And now that very like expensive talent is within reach. So from those sectors perspective, this is actually a hiring opportunity, not a hiring drought.
Guys, it's still a good time to look for a job. I guess how much does the potential employee, the person who's searching for a job, how much of that upper hand do they still have, if at all?
Well, I think it depends on what your perspective is. If you're coming and looking, is this as good a time as it was in late 2021, 22? It's definitely not as good as that. Like that was an exceptional time where I always joke people were almost like walking out the door and like 5 employers were begging them to come to work that day. And people were able to like start a job and then without a second thought, quit it within a year. And we've seen that come down, but it's still, again, a perspective is in 2018, 2019, we were all in these, talking about labor market saying this is a very good labor market. We're starting to compare it to the late 90s boom. And if we're in that state, I think by historical standards the last, few decades, this is still, and particularly in sectors that have not been hard hit by a downturn. So outside of tech and, for example, professional services, this is still a fairly good job market.
In terms of that debate that we've been having about the office space, hybrid versus full-time, what are you hearing from companies on how much flexibility they're still willing to offer?
Well, it's interesting because the way I sort of think about remote work is aside from trying out something totally new to the pandemic, it was this benefit that employees really like and employers are obviously somewhat more reluctant to offer. And as we've seen some of that bargaining power shift back from the great reshuffle period of late 21, 22, when employees really had the upper hand, to now where some of that upper hand has ebbed away is, employees we're still seeing a huge chunk of job applications to remote jobs, but the prevalence of those remote jobs within the overall job postings has fallen a lot. So from an employee's perspective, it is much harder to procure remote jobs. Employers definitely are having, in our data, more of an upper hand bringing people back, at the very least to hybrid, if not to fully on-site work.
Yeah, it's been interesting to see how that conversation has evolved. LinkedIn's economist, Guy Berger, good to talk to you today. Appreciate the time.
Thank you.
Chipotle is amping up its world of automation with Avocado. It's a new member added to its robot fleet. With all of the tasty details, we want to bring in Yahoo Finance's Brooke DePalma. Avocado, I hadn't heard of it before. Apparently I should have. So what is it?
Well, take automation, take avocado, and you get Avocado here. This is the avocado processing prototype that Chipotle is currently testing at its Cultivate Center in Irvine, California. Now, the company aims to roll this out at one of its restaurants later on this year. It's creating a collaboration with an automation solutions company, and here's exactly how it works. Ultimately, it starts with an employee and it ends with an employee. An employee has to load the robot with a full case of ripe avocados. That's up to 25 pounds. Then the avocados turn vertically and then are transferred into a processing device. They're then sliced in half. Their core and skin are removed, and the waste is discarded. Now, the fruit is then collected in that steel bowl at the bottom, and then an employee has to remove the avocados to make the signature guacamole. Now, in terms of how long this process takes right now by hand that the employees are currently doing at all restaurants, well, it takes about 50 minutes. Now, a spokesperson from Chipotle said that with the avocado, it will ultimately save and reduce prep time by about 50%. And Chipotle goes through a lot of avocados. The company is expected to use nearly 4.5 million cases of avocados this year, and that's equivalent to more than 100 million pounds of fruit. But Chipotle did not share just how much money it makes in guacamole sales.
Brooke, you would think they'd be using like a food processor, right? I mean, I just think about how long it takes to chop up all the veggies for guacamole. That I find the most tedious part of making guacamole.
Me too, Kiko, me too.
Yeah. This obviously isn't the first foray into automation for Chipotle. What are some other robots?
Yeah, well, one other robot that we've talked about many times on air is its robot Chippy that actually makes tortilla chips. So as you can see right here, this is something that the company rolled out last fall. And Akiko, this is all part of Chipotle's bigger plans. It's part of their venture fund called Cultivate Next Fund, where it intends to invest in forward-thinking ventures, drive meaningful change at scale, and also accelerate Chipotle's healthy, robust, aggressive growth plans that it has. And the CFO has weighed in before on just exactly how much it's investing in AI and automation. Ultimately, he also said that there are endless possibilities, but there are also a lot of pitfalls. They said they want to be very careful and very thoughtful about how exactly they approach automation and AI, but investors seem to be liking all this innovation. As you can see right there, compared to a year ago, shares are up more than 64%. Year-to-date, shares are up nearly 50%, and this is just one of the major fast food chains that we're seeing turn to automation to increase efficiency, increase a keyword throughput in stores. We also saw Sweetgreen out with their Infinite Kitchen, where ultimately they're also using a robot to help make salads. And so certainly lots more to come, maybe not only from Chipotle, but other restaurant chains as well.
I like the names. They're cute. What, Chippy?
Catchy, right?
Avocado.
Chippy, avocado.
What's next? You know, you got to think of something that makes
we'll have to say
something. I don't know. All right, Brooke, thanks so much. Well, coming up, it is closing time here at Yahoo Finance. We will recap the top stories of the day and get you set up for everything you need to know ahead of tomorrow's opening bell. We'll be right back.
It is closing time here at Yahoo Finance. Here are some of the top stories of the day. Inflation showing signs of cooling down. The consumer price index climbing 3% in June. That is the slowest pace of growth in more than 2 years. Prices for used cars and airfare fell last month while rent increased at the slowest one-month pace since last year. Today's report signals that the Federal Reserve may be done raising rates after an expected rate hike later this month. Meanwhile, Elon Musk is launching a new company. He announced the debut of XAI on Wednesday, focusing on artificial intelligence. The company's website says its goal is to understand the true nature of the universe. And Musk will take part in Twitter Spaces chat about the company on Friday, July 14th. And say goodbye to Bye Bye Baby. The retailer is closing all of its stores as part of the liquidation of Bed Bath & Beyond, its parent company. A judge approving the sale of Bye Bye Baby's intellectual property for $15.5 million. That went to a New Jersey-based company. That deal does not include the chain's 120 physical store locations.
Let's take a look at what to watch tomorrow. Investors have a slew of earnings to look forward to, starting with PepsiCo. The company is set to report its second quarter results tomorrow ahead of the market open. Pricing gains may once again help the company's top-line growth, with analysts expecting $21.7 billion in sales on earnings of $1.96 a share. This as investors will be keen to see if volume levels return to growth. We know that's a key data point here for this earnings report. Shares up just a bit in extended trading here, up just about 0.1%. Another earnings report tomorrow on deck is Delta Airlines. The stock has been flying high in 2023, with shares up over 40% year to date amid surging demand for travel. Higher airfares, also easing fuel costs, expected to help quarterly results. Consensus is for revenue of $14.44 billion on earnings of $2.41 a share. And last but not least, we'll get another look at the consumer with Conagra Brands. Now, expectations are for sales of $2.99 billion, essentially $3 billion, on earnings of 59 cents. Price gains may help drive that top-line number. However, supply chain disruptions will be a headwind for investors to watch.
That does it for Shauna and I on this Yahoo Finance Live. Be sure to come back here tomorrow at 3 p.m. Eastern for all of your coverage leading up to and after the closing bell.